Hey guys, welcome back to the channel. Today I'll be talking about options, more specifically synthetic longs, along with shorting the stock and trying to capture some arbitrage opportunities. So this is kind of a back test, and what I'm trying to do is long the stock via options by shorting a put and buying a call at the same strike while also shorting the stock. I'm not going to go into put to call parity, but essentially it's similar to that, except we don't involve any bonds. Whereas in put to call parity, you would involve buying or selling some bonds. So it's not exactly that, but it's very close to it. So I recommend you read up on how put to call parity works because there are some arbitrage opportunities, but the profit margin is very thin, as we will go over in some examples here. So I'll start off by reading in my options, and I'm getting all my options data from CBOE. So here I'm just reading in some files. Now I'm going to go over two scenarios. So the first scenario will be when the stock is lower than our initial entry price, and the second will be where the price is actually higher than our initial entry price. So I'll go over those two examples. So I'll go ahead and read in the files, and I'm only going to look at Ford stock. So after I read in the options, I guess I can show you how I keep these and how the format actually looks. So this is all CBOE data, which includes Greeks, prices, and stock data. If you want to learn how to pull this data from the CBOE site, I do have a video showing how to scrape that data off their website. So after I bring in the data into RStudio, I'm just going to subset by ticker, which will eliminate most of these. So I created a function called getSyntheticLongs by just passing in the ticker. So if we open up this function, I'm subsetting my options data to just include that ticker. I'm going to go ahead and save the date or the timestamp in my options data so that I know what date I scraped these options or what trading day these are for. I'm going to get all unique expirations and save them into this variable called exp. I'm going to pass that as a list, and if we open this up, our function is subsetting by expiration, by strike, and then I want to group these in straddle form instead of having just a long list, since that's a little bit more easier to the eye. I'm going to get all the unique strikes and pass that into another function. So inside that function, I'm going to separate the calls and the puts for that particular strike. So we should essentially have a call side and a put side for each strike. I'm going to group just a couple of columns, which includes the mid price for the call option and the put option, the change, the percentage change, the delta, gamma, theta, the calculated implied volatility, the volume, open interest, and of course the strike price. And I'm going to do that for the call side and the put side. I'm just going to rename some columns. So after I group that data, I'm going to combine both the call and the puts by using cbind. So again, we'll have this straddle view. Now to calculate the synthetic long, I'm going to just use this formula, which is just the mid price of the call option minus the mid price of the put option plus the strike price. So if we go into TD Ameritrade, I'm just going to show you the payoff. So here we have the options chain for Ford, and the expiration date is November 12th of 2021. So let's just say we want to buy a synthetic. For this expiration, I'm just going to buy the call and sell the put. And if we take a look at the risk profile, we have essentially made the same payoff structure as just buying regular shares into the stock. So it does come with a break even, which is essentially what you paid for the call minus the put premium you receive. So if we were to buy this combination, we would actually come out of pocket approximately 30 cents. And if we kind of scroll in or zoom into this payoff structure, since these are for the $16 strike, our break even is $16.31. So since I'm looking for arbitrage opportunities, Ford stock has to actually be trading at this price. So if we add the stock, so it's trading at 16.28. So there's some discrepancy there. All right, so in order for us to make this to work, I need to sell 100 shares of the stock, which is trading at 16.28. So let's see what that would do to our payoff structure. So I'm going to go ahead and short it, and I need 100 shares since each of these contracts represents 100 shares. So we take a look at our risk profile. So now we get a flat payoff structure, but since this is trading at 16.28, so if we were to buy this combination, would actually lose $3. So what this backtest will search for is look for combinations where there is a discrepancy. So let's just say Ford is actually trading a little bit higher than 16.31. So now our payoff structure becomes $2 at expiration. So that's what I'm trying to find in this backtest. So if we go back to our R script, if we continue down the script, we will find the difference between the stock price and the synthetic. And I'm also going to add a column which indicates if this is trading at a discount, at a premium, or if it's trading at par value. So after it's done making those calculations, I'm going to row bind all these options, and that's what I'll actually return. So if we minimize this, after I calculate all the combinations, I'm going to add the cost of the buy side, and that's just the out-of-pocket cost. So since I'm buying the call, I need to pay the premium for that call, and since I'm selling the put, I need to put up the margin, so that becomes a cost as well, and I'm going to multiply that by 100, so that'll get us our dollar cost. And on the credit side, we just get the premium for selling the put, and I multiply that by 100. And if we find the difference of these two, we get our net cost. So I'm also going to be adding a column for that. So the reason I chose Ford stock is because it has a relatively low stock price, which makes it easier with the margin requirements. I'm also going to add the symbol as a column and the date. So it'll do that for all the expirations and all the strikes. So let's go ahead and use this function. I'm going to go ahead and run it. I'm going to go test the function. And if we take a look at that data frame, so all these columns that start with C are on the call side, and we get a divisor, which is the strike and the expiration. And then we have our put side, and all these columns begin with a lowercase p. We add our days to expiration, where the stock closed that day, the synthetic options price, the difference between the synthetic and where the stock closed that day, and here we get our indicator that lets us know if it's trading at a discount or a premium. Next we have the debit side. So if we were to buy this combination, our out-of-pocket cost would be $14.88. We wouldn't get anything as a credit, so then that becomes $14.88, but we can actually sort these, and if we sort these from lowest to highest, we see that the largest discrepancy is for this combination with 39 days to expiration. So our stock closed at $14.87 and the synthetic is actually priced at $13.51. So there's $1.36 of a difference. So if we take a look at the strike, this is for the $5 strike that expires, or that expired 7/23/2021. So I'm going to pass in some information which will give us our entry and our exit and the net profit if we were to buy in the synthetic and sold short our stock. But as a caveat, the differences won't be as large. You will most likely find maybe a couple of cents of a difference if you're lucky. This $1.36 was just probably because this is after hours. Most of the market makers don't add any quotes for the options, so those quotes go away, making our bid and our ask for the options much wider. But let's just see how this would play off. So the date is actually 6/14, so that's when we would have bought, and we need to hold that until expiration, which is 7/23. But if we take a look at the stock chart, so this is Ford, we would have bought at 6/14, which is in here, and sold at 7/23, which is this price here. So we see that the stock actually declined during the length of time we actually held these options. So let's take a look at our next function. All right, so we're going to go ahead and get the results by passing in our data frame of synthetics along with the expiration we want, the strike we want, and the number of contracts we want to purchase. So if we open up this function, so I'm going to subset this data frame by the expiration and strike we choose. I'm going to get some stock data. You see that I actually subset that range. I'm going to extract the closing price and make it as numeric. I'm going to calculate the call price and the put price at expiration. So here I left some notes. So for the call side, if the stock is less than the strike, then the option price would be 0. Otherwise, it'll be the stock close minus the strike. On the other side, if the stock close is higher than the strike for the put, then it would be 0. Otherwise, find the difference between the strike price minus the close. So to calculate the P&L, for the stock, I'm going to grab the stock close, which is the price at expiration, minus our entry price, multiplied by 100 times the number of shares or contracts. And then I'm going to get the percentage return. And I'm also going to do the same for the options. So our entry price minus what we paid times 100 times the number of contracts. All right, so now we need to aggregate the cost. So trade cost was our entry price for the stock times 100 multiplied by the number of contracts plus the net premium we paid for the options times the number of contracts. So our gross P&L just becomes our stock P&L plus the call P&L plus the put P&L. So I'm going to aggregate some columns for our entry or opening prices and also our exits, which include the stock price, the strike, the mid price for the call and the put, the number of contracts, the debit side and the credit side, and I'm also going to return our gross cost for the trade, and then I'm going to compare that to what happened at expiration. So essentially the same thing, but at expiration. I'm formatting some columns here so that they match. I'm going to go ahead and row bind the two, and here I'm just going to make some calculations. So essentially I'm just going to subtract the first couple of columns and add the rest, so that'll get us our net difference. And I'm going to find the difference between the put premium we received to the premium at expiration. I'm going to add gross cost, and then finally just return that as a data frame. So our first row will be our entry, the second row will be the results at expiration, and the third row will just be our P&L. So let's just go ahead and minimize this function. I'm going to run this function, and I'm going to test that combination. So if you remember, it was the $5 strike that expired 7/23. So if we run that line and we take a look at that data frame, so here the entry price was $14.87. At expiration, our stock was trading at $13.82. So I lost $1.05. Since I was finding the difference between the first couple of columns, the strikes net to zero. Our call price at the beginning was $9.57. At expiration, it was trading at $8.82. So I lost 75 cents. And on the put side, since it was out of the money, it expired worthless. So I lost a total of $1.06, or all the put premium. If we were to make this trade happen, we would have bought 10 contracts. Our out-of-pocket cost would have been $14,570. We received the credit for the put, which was $10.60, and we also shorted that stock at $14.87, essentially shorted 1,000 shares, which would have been this amount. So our total net out-of-pocket cost would have been $28,380, and at expiration, since it was trading at $13.82, this is how much the stock was worth. So there's a difference of $750 plus the credit we received of $10.60, and since we shorted the stock, we made a profit of $10.50. So if we add these three, we get $13.60, which, if you remember, if we take a look at our synthetic long data frame and we sort this by our difference, it is essentially the $1.36 multiplied times 100 by the number of contracts. So it does coincide with this payoff, and all we had to do was just buy at these prices and hold until expiration. So now let's take a look at another example in which the stock is actually rising. So we take a look at our script. I need to call in the options file for that date. So I'm going to go ahead and run this. And for the case where it was rising, I'm going to go ahead and read in the options. And then I need to calculate the synthetic longs for that data set. All right, so if we take a look at the range where it was actually rising, here we'll have two scenarios, one where the put is out of the money and the other where the put is in the money. So I'll explain both scenarios, and I'll show you that in the stock chart as well. But I need to get the date. So the date was 9/8, and we need to hold until 10/15. So on our stock chart, we see that 9/8 is this date here, and 10/15 is this candle here. So we had a substantial run up. So we'll take a look at the scenarios. So since the strike price is 8, we'll get the rise scenario. So we open up that data frame. We see that our starting price was $13.03. At expiration, it was $15.70. So that's the P&L for the stock, P&L for the call and the put. I'm only using one contract. So our out-of-pocket at the beginning was $13.05, $15.70 at expiration, leaving us with 265 in profit, which came from the call side. We received a $3 credit for selling our put. We shorted the stock at 1303, but since it ran up to 1570, we actually lost 267. So if we add these three columns, we net 1, and the total cost of the trade was 2605. So not great returns, but at least we have a guaranteed payoff essentially. Now let's take a look at the case where the put is actually in the money. So I'm going to use the $30 strike, same expiration. And if we take a look at that data frame again, so same results except the call price lost a penny. The put price went from 17 to 14.3, so I lost a total of 270. On our debit side, we have negative 3001. At expiration, it was just 3000, leaving us with -1. So on the put side, we collected 1700, but since this is still in the money, put is now worth 1430, leaving us with 270. And since we shorted the stock, we lost 267. So our net was $2. And the cost of the trade was 2604. So in the cases where the options are still in the money, you need to trade out of it to avoid assignment, and different brokers have different rules, but the best case is just to trade out of it. So these are more realistic payoffs for these options. I assume, I haven't actually tested this in real time, but in our next video I'm going to try and build an algo that just searches for the highest payoff, and we're going to try and send some orders and see how that works. So stay tuned for that. Please subscribe to the channel if you haven't done so already. Thank you for watching, and I'll see you guys in the next video.